I want you to imagine for a moment you bought a one-bedroom apartment in 1980. At this time, a one-bedroom apartment cost around $55,000 in Sydney, Australia. Fast forward to 2024, the purchase price of a one-bedroom apartment sits anywhere between $600,000 and $1.4 million. This means that in 1980, you could have bought an apartment outright for less than what it would cost for a deposit on a new one now. Back then, you could get away with making a few mistakes and still come out on top. This is no longer the case. Now, more than ever, buying an investment property, if done wrong, can be the most expensive mistake you'll ever make in your life. This is why it's critical to learn from the mistakes investors have made in the past. In this video, I'll be taking you through the top 5 pitfalls that have taken out millions of property investors just starting off, to experts who thought they knew it all, and you're at risk too. For example, in just 1 year, from 2022 to 23, over 250 Australian property markets lost their millionaire status, making the country's $1 million club even more exclusive than it already was. No one can predict the market for certain, so the best thing we can do is lessen the chance of us making a mistake. So without wasting any more time, let's get into the first expensive mistake I've seen a lot of property investors make: not investing off the belief that the market will eventually have to crash. In other words, believing that the market will ultimately have to crash due to unaffordability. This is a widespread belief that one day housing prices will plummet because the average citizen will no longer be able to afford a home. People all over are saying the income and housing prices have been divided so much due to these property booms that there is no way this upward trajectory can be sustained. But the truth is, there will always be wealthy people out there who will continue to buy homes. There have actually never been more rich people in the world than there are right now. And with the housing crisis, the gap between the rich and the less fortunate continues to grow. In fact, the biggest problems Australia is experiencing at the moment is not that people can't afford homes, but there aren't enough properties for the demand. The national vacancy rate sits at just over 1%. This is incredibly low considering we welcome almost 740,000 immigrants into Australia from 2022 to 2023. And another reason why property prices can continue to go up is because of the dollar. Every time there is an economic crisis, more money is printed, causing our currency to depreciate. Because unlike gold or other precious metals, our currency is not pegged to a sustained value. The reality is, you should have started investing in 1980, even if you weren't born. That's just tough luck. But there is currently no better time to invest than now. So don't let this belief of a better tomorrow stop you from taking the next step today. The second mistake is investing in locations that have already boomed too much. You see, places like Gold Coast and North Adelaide are exploding by 70 to 80% over the last 4 years. So naturally, people try to get a piece of the pie with the belief that prices will continue to go up. However, what I've found is the biggest limitations for growth is past growth. There is only so much one suburb or city can grow before it becomes completely unaffordable for locals living there, in the short term at least. So as tempting as it can be, and trust me, even I've been tempted, but try to avoid these areas that have had massive 60, 70, 80% growth spikes and look for the places that have shown steady growth but still have the potential to boom in the future. And if you're wondering why you probably haven't heard many professionals talk about this in the past, that's because people make a lot of money off this belief. This idea of, hey, this place has almost doubled, so surely it'll keep going up, is an easy sell and gets many people to buy in these locations, so try not to be fooled by this. The third mistake I see many investors make is buying in their own backyard. Perhaps your mum or your uncle have seen great capital gains from their homes they've bought 30 years ago and might try to convince you buy something close by or in the same suburb. The chances that the suburb of the area you grew up in is one of the best places for you to invest in is extremely low, especially in a place like Australia where we have over 15,000 suburbs to choose from. So you're just gonna have to politely decline your family's invitation and do some digging of your own first. And this segues perfectly into the fourth mistake I see a ton of people make, which is getting too emotionally attached to your investment property. Buying a property in a place you grew up can be a bad decision because of all the memories and emotions that usually come attached to it. Walk down the street and, oh, that's the sporting ground where I used to play soccer with my mates. Or, oh, that's the local pub where me and my mates used to get Anyway, all of these emotions can affect your ability to make fast, logical decisions and could cause you to keep an investment property longer than you should have, which could lead to you missing out on a big win. Instead, what you should do is look into all the best places to invest in the country and then put your money in that pile. You don't always have to worry about seeing it in person. Just try to get a recommendation or find yourself a really good property manager and they'll look after it for you just fine. Well done for sticking with me this far. Consuming videos like this, you're truly on your way to becoming a big-time property investor if you aren't already. Just before we get on to the last costly mistake, if you found this video valuable so far and want to stay up to date with the latest property investing information, hit the thumbs up and click subscribe as it helps me out as well. Win-win for both of us. All right, I won't hold you up any longer. Let's get on to number 5. If you don't get this one right, it'll make the rest of the investment journey 10 times harder. This one is important because it's the absolute foundation when it comes to any form of investing, especially property. What I'm talking about is investing without a clear game plan or strategy. People who invest without a clear understanding of what they're aiming for end up just shooting from the hip. Then, most road bumps they run into later on are usually a result of this one mistake. When investing, you need to know what the purpose of the investment is. Are you going for growth or are you going for cash flow? You need to have a good sense of direction before pulling the trigger. There are 2 great ways to give yourself a really good shot. One is to get a mentor, someone who knows the market, who's been in the game a long time and has the evidence from the past performance that they know what they're talking about. Now, most people don't have direct access to the possible mentors in this field, but don't worry, not all hope is lost for you yet. The other great way to get the foundations right is to consume really good content. There are many experts out there giving insights into property investing, so take advantage of all that free information. Now that you're familiar with these pitfalls, you'll hopefully avoid them, keeping more money in your pocket. But it's fair to say you still want to make the most out of the properties that you buy or already have, right? Well, you should check out this video we made on the 17 best tax deductions you can claim on your property. This video is not even 10 minutes long and has saved my clients tens of thousands of dollars. Just click on the video to watch. All right, guys, that's it for me. Thanks for watching. See you next time.